And frankly, my belief is that the existing system can't fail quickly enough because it's hurting a lot of people. I personally believe that sound money is the problem of our age, and that the fact that we have unsound money is why our society is going through all the turmoil that it's going through politically and otherwise. And I think that the inflation that we're suffering through, it's not a bug, it's a feature of this system, and it's going to continue and it's going to get worse. It's tragic. It's absolutely tragic. The suffering caused by the Federal Reserve is galactic. I mean, it's beyond the pale. I believe another big print is coming. I don't think this inflation is going to get better. Our kids will, live in a world without a Federal Reserve, and they'll look back at it and they'll say, what were we thinking, letting 12 guys set the price, 12 people set the price of money? I mean, it'll be like bloodletting. They brainwashed us and gaslit us into thinking inflation is good and it will fall into a deflationary depression if we don't have it, which is just a blatant lie. We're in a sovereign debt crisis, and the value of bonds have been going straight south, while the value of gold and Bitcoin, the alternatives, have been going straight north. We're going to have a lot of inflation, and eventually people are just going to say, oh my God, please, please, please stop this inflation. We need to have sound money.
This is The Real Story with Michelle Makori.
Hello, thank you so much for joining us. I am Michelle Makori, and you're watching The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to show you what is really happening with money, markets, and power. And today we are starting with a concept at the very foundation of it all: sound money. Because if the money isn't sound, the system isn't sound. And right now, many argue that our entire economic, financial, and political system is broken and on the brink of collapse, precisely because it is not rooted in sound money. So what is sound money? Well, technically, sound money must fulfill the classic functions of money. It must serve as a medium of exchange, a unit of account, and a store of value. It also needs to be divisible and portable. But here's the critical part. It must be scarce. It must have limited supply. It cannot just be printed out at will or created with a click, as our money today is. So why does sound money matter? Because when money is sound, your savings hold their value. Your work is measured fairly, and wealth cannot be quietly stolen through money printing and inflation. Unsound money, on the other hand, erodes purchasing power, drives inequality, and shifts wealth from savers and workers to government and elites. Unsound money leads to inflation, a hidden tax that hits us all. Unsound money also historically leads to social unrest, political instability, the collapse of institutions. Now, the word sound itself comes from the Old English sunt, meaning healthy, safe, reliable. So when we talk about sound money, we are literally talking about healthy money, money that is stable, trustworthy, and not easily corrupted. Historically, that is why societies gravitated to gold and silver. Not because politicians decreed it, but because these metals were scarce, recognizable, and could not be printed at will. The founding fathers of the US understood this deeply, and after the collapse of the continental currency during the Revolution, a paper money that became worthless, they wrote into the Constitution that nothing but gold and silver could serve as legal tender for debts. George Washington himself warned that paper money would ruin commerce, oppress the honest, and open the door to every kind of fraud and injustice. But today, we don't have sound money, and we haven't for a while. In 1944, Bretton Woods made the dollar the world's reserve currency, backed by gold. And in 1971, President Nixon severed that link, shutting the gold window and leaving us with pure fiat or paper currency. Money that can just be created by government decree. Now, Austrian economists believe that sound money isn't just about economics, that it also serves as a safeguard for individual liberty, limiting the power of governments to manipulate and control. Sound money gives us stability. So again, when we talk about sound money, what we're really asking, is our money healthy and fair? Is it a true representation of energy and effort and time? Now, gold remains the classic example of sound money, but many argue that Bitcoin also fulfills the definition. And my guest today is a fierce advocate of sound money. He says that fixing our broken money is the only way to fix a system which he says is collapsing, and quickly. Larry Lepard is the author of The Big Print, What Happened to America and How Sound Money Will Fix It. He's also the founder of Equity Management Associates, focused on providing monetary debasement insurance through investment in gold and silver miners and Bitcoin. Larry, so good to have you with us. Thank you so much for joining us.
Well, thank you, Michelle. It's an honor to be here, and congratulations on your new gig. It's nice to see you back in this game because you're so good at it. And that introduction to sound money was much better than I could have given, so bravo for that.
Well, I doubt that, and I got inspired from your book. And, I thought it was important to start off with that introduction and with that definition of sound money, because I often say, oh, I'm pro-sound money. That's why I like gold and Bitcoin. I'm an advocate of sound money, but not everybody understands what it is. And not everybody understands a lot of big macro concepts. And that's why your book is so fantastic, because it really breaks down the history, breaks down the themes, and explains how we got to where we are. And where we are, according to you, is not a very good place. So we have a lot to discuss. I do want to start off with some background with the book that you write, which is exceptional. And then we'll get into your outlook on where we are now and what it means for gold, Bitcoin, the dollar. But let's start off with the book. And you write in there, we have built our financial system on a bedrock of sand, not sound money. It is collapsing. So take your time and break that down for us.
Okay. Well, it's a long story, but and I know you've got a clip of Nixon taking us up the gold standard, but there have been a number of events. I mean, the founding fathers obviously wrote the Constitution based on sound money, and since that time, we've slowly but surely slipped away from it, and more recently in a very accelerated fashion. There were many, many steps along the way, and the book details those. I mean, even back in 1865, the Civil War, Lincoln created greenbacks, which were by definition unsound money, so that was a test case. But the Federal Reserve came along and they created a backstop so that banks could create unlimited amounts of money and not have to worry about the penalty of doing so. And then probably the biggest, Roosevelt grabbed all the gold in the 30s, and that was another bad step. But probably the biggest, most modern step that most people remember and can relate to is Nixon taking us off the gold standard in 71, as you pointed out. And everything became fiat, and then since then it's only gotten worse. But kind of incrementally, it's like small leaks in the dam, but now the leaks have gotten quite large. And so more recent events. I mean, the book is called The Big Print, and it's funny because I believe another big print is coming. But we've actually we've had two big prints. We had one in 2008 when the Fed balance sheet went from 800 billion to 3 trillion plus. We had another in 2020 when the Fed balance sheet took another jump up to a peak of, I think, 8 or 9 trillion. It's now back just under 7. And I think there's another one coming. And so I personally believe that sound money is the problem of our age, and that the fact that we have unsound money is why our society is going through all the turmoil that it's going through politically and otherwise. And I think that the inflation that we're suffering through, it's not a bug, it's a feature of this system, and it's going to continue and it's going to get worse. And so I think we had a 40-year deflationary trend, which we can talk about. I think a lot of people, including politicians and others, hope that, 2008 was a one-off or 2020 was a one-off, and, we'll get inflation back under control and we'll go back to operating the way we were operating. And I don't think that's a true statement. I think, sadly, we now live in a very inflationary world, and I think most of us see it, that it's bad and it's getting worse. And so, with the book, what I tried to do, and I wanted to do, and the fraud that's been played out against people, the average person, it's sophisticated. I mean, this is not something that you learn in school. They don't teach it in school. And what I wanted to try and do with the book was to explain to everyday people, any station in life, didn't have to have a finance degree, how and why they've been taken advantage of, and how we got away from this very important core principle. And that if we want to restore our society to what it used to be in earlier times, we need to get back to sound money. And I mean, so that's all the bad news. The good news is, the book's two parts. Part one is, what's the problem? It's that we have unsound money. Part two is what's the solution? And it's a return to sound money. And I think what the markets are saying to us is we're going there. And the reason we're going there is that the system as we now have it isn't working, and that's getting more and more apparent as we go along. So we can launch off from there, but there are a lot of paths we can go to discuss that.
So let's focus on the big picture before we get into the details and your sort of core macro thesis. Why is the system broken? Why are we in what you call a sovereign debt crisis? Explain this very pivotal point in time that we're in, and why you think that we're on the brinks of collapse.
Why is it acute? I mean, it's acute because of math and compound interest. And so, One of the charts I like to show very often is the growth in GDP and the growth in the debt burden. I mean, when you start taking on debt to grow a society, it can be a good thing. This just goes to show you how acute the problem became in 1971. This is a chart of inflation from 1800 to 2005, and of course it keeps going up after 2005. It's just the best chart I could find. And what it shows you is that wars were generally inflationary, but somewhat amazingly, throughout most of the 19th century, inflation was not a problem. And then it began to become a problem post-World War II, and it became a very severe problem after 71 when we went off the gold standard. And so we now live in an inflationary age because we have fiat currency. And as a result of that, what's happened is in an inflationary environment, it makes sense for people to use debt to fund growth. And so they borrow knowing that they'll have to be able to pay back in diluted dollars. And so our debt growth has been in excess of the rate of growth of the GDP. And GDP are the goods and services that we produce to service the debt. And in the beginning, that kind of feels good. You can get some growth and you feel like there's not too big a price. I mean, I remember when Reagan started running deficits and everyone complained about it, but frankly, the economy boomed and he got some decent real growth. And we also defeated the Soviet Union by doing that. But at that point in time, debt to GDP was 20 or 30%. Today, debt to GDP is 125%. So it becomes a much bigger problem. And I have other charts that will show just how rapid that debt growth has become. And eventually, the math just overwhelms you. It's like the family that's taking out credit cards to pay the minimums on the old credit cards. Eventually, flip forward a few charts if you can, or if you want me to, I can share my screen. But I can show you some of these what I'm talking about. Let me just I'll put up the debt to GDP. And then I'll go to Zoom and I'll hang on a second. Ugh. Ugh.
Well, while you're looking for those charts, as you said, part of this, or the sort of pivotal point, was when we went off the gold standard, something that you called a galactic mistake. So right. while you set up those charts, let's play that soundbite from Richard Nixon when he made the announcement in 1971 that he will be taking the U.S. temporarily off the gold standard. And, you can explain why this was such a crucial moment in our monetary experiment.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what is this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar.
Well, go ahead, Larry.
Yeah. So, and of course, that's not what happened as the prior chart that I just showed about inflation. I mean, the 70s were massively inflationary, and it took 20% interest rates, which nearly bankrupted my father, to bring that under control. And they did bring it under control. But let's look at another chart that is up on my screen now. I hope you can see it. This is a chart from the early 70s, 71 time frame to present of the bottom line is U.S. GDP and the top line is U.S. debt. And think about it, the GDP is the productivity of the country, and we use that to pay the interest on the debt. And you can see that way back in the early 70s, they were fairly balanced and this wasn't a problem. And we went off the gold standard, and even then, although we had some inflation, they got it back under control and it didn't really become a problem for some time. But what eventually happened is that people, governments and financiers realized that the debt was a way to get themselves to, in government's case, spend more than they had, and in financiers' case, get wealthy by borrowing money that they knew would depreciate. And so we grew our debt burden much more rapidly than we grew our GDP burden, GDP underlying which pays for it. And so the combination of those two things has now led us to what I call a sovereign debt crisis. And so, we just, it's really kind of quote unquote gotten out of control. Let me show you a different way of looking at it. This is the United States debt burden from inception to present. And, it almost doesn't register until 1971. And what you can see here is that from 2020 to present, we've added 11 trillion of debt. I mean, it took us 220 years to reach 11 trillion of debt. And so, you've now reached the point at which the compounding effect has just gotten so extreme that, we run deficits every year. I just checked the Congressional Budget Office estimate for the deficit this year is 1.9 trillion, just like it was last year. And in spite of DOGE and higher revenues coming in from tariffs, the big beautiful bill is going to turn around and spend all that, and probably more so. So the problem is really a problem of growing debt, and debt in excess of what the underlying economy can support. And so that leads to further problems down the line, which we can explore. But that's really the core of the issue, the fact that the U.S. government can't balance its books. And so the dollar is a representation. It's maintained by the Federal Reserve and the U.S. government. And the notion is that it has value because there's some limit on the supply. And in fact, when you grow debt this quickly and this large, you make interest expenses what they are now, they're over 1.3 trillion a year, you get into a situation where you need to print dollars in order to service the debt. And of course, that's inflation by definition. If M2 is growing rapidly, you have inflation. And so what I would submit is that we're now in a situation where it's very, very hard to turn back. And the way this typically ends with countries that do this is you have extremely high inflationary conditions. In the worst case, you have hyperinflation. I'm not suggesting the U.S. is going there. That's a tail event. But it's not impossible. It's not out of the question. And if you look at the policies that we're pursuing right now, they definitely look like the kinds of policies that were pursued by other countries that ultimately had a very high rate of inflation.
But why is this a critical tipping point in your mind?
Well, you can see it, I think there are a couple of big events that showed you that it's close to being a tipping point. One was '08, the great financial crisis. And let me show another chart here that I think is useful. Yeah, this is a very interesting chart. This is by Lynn Alden. So what you can see here, the top line is total debt in the U.S. It's now actually up over 100. This is a little out of date. And the bottom line is the base money supply. And what you can see, Michelle, is that in '08, when the GFC happened, in order to support this debt, you have to have money in the system to pay it off. And in a debt-based system, you need to create money to service the growth in the debt. And what you can see is that things changed markedly in 2008. And they changed in '71 as the lines started to diverge, but it didn't really become an issue in 2008. And then we had 2008, which was the great financial crisis, and suddenly they realized, oh my God, we've got to create a lot more money in order to keep this thing going. And they did. And what we had is it's in my book, but they stabilized it through changing the rules of interest on excess reserves. And so it didn't manifest in terms of consumer price inflation, but it manifested in terms of asset inflation, which has now created what I call the everything bubble. Other people call it that as well. And so, at that point in time, we grew the money supply massively. And then, of course, we tried to reduce the debt, as you can see, coming down into 2019, and Powell was forced to pivot. And of course, COVID hit, and we had to grow it again. And so what you can see is that although we've brought it back down somewhat, the Fed has been tightening, you can see that the debt level just continues to grow, and it's only a matter of time until we have to do it again. And so that's why there's some who say I should have named my book The Bigger Print, because we've had two big prints and there's another one coming. As long as that top line keeps growing, that bottom line is going to have to grow. That's just math. And so therefore, that's the answer to your question of why is it inevitable that we have a lot of inflation at some point. Now, knowing exactly when it's going to hit, that's a little bit dicey. You don't know. It could be tomorrow. It could be a year or two. But I'm very comfortable that another big print is coming because I can look at this math and see why.
So what are the consequences of another big print, of more inflation? Why is this so problematic?
Yeah, well, they're very simple. I mean, if you grow the money supply, you take rates down, which is what Trump wants to do, and you're forced into yield curve control. Let's talk about. Let me define what yield curve control is. Let's just talk about that for a moment. I mean, we're in a sovereign debt crisis, and what that means is that the U.S. government, is spending way too much money way too quickly, and the value of bonds have been going straight south, while the value of gold and Bitcoin, the alternatives, have been going straight north. And what's going to ultimately happen if we don't get this under control, and I think it's unlikely that we will, is that the U.S. federal government bonds are going to start to sell off even worse. And as you know, as most people now know, U.S. interest expenses are about $1.3 trillion. That's larger than defense. It's as large as Social Security. And you're going to get to the point where the interest expense is going to eat up the entire budget. And so you get into what James Lavish and I have called, and others have called, a debt death doom loop, where your interest costs go up. That makes your deficit larger. The larger deficit means you have to sell more bonds. You're selling bonds into a fixed supply of buyers of bonds. They don't want them at that interest rate, so the interest costs go up more, and you can see where we're heading here. So, and this has happened in the past, and so what happens to solve that, what the government does is they say, okay, fine, we're not going to let the interest rates go up beyond a certain point. We're going to institute what we call yield curve control, which means they are going to buy the bonds with money they print. And they can do that. I don't think any sovereign bond of the United States will ever default, because we won't let that happen. But you can effectively default if you print money to pay the bonds back. And so the bonds, yes, we're going to pay you what you're entitled to get in principal and interest, but what's it going to buy because of the inflation that's going to create? And so, it's not unusual to see this happen. It happens in emerging countries. It's happened in other countries that have pursued the policies that we're pursuing. And it actually kind of happened in the United States. I think there's a very interesting analog that I'd like to bring up. Coming out of World War II, we had about the same level of debt to GDP. It was around 110, 120%. And that was because obviously running the war was an existential threat, and we had to borrow a ton of money to get through World War II. And so, we came out of that. And when we were in that war, what the Fed did was they said, we're going to cap the short-term bills at 0.3%, and we're going to cap the longer-term, bonds at 2.5%. And so, people who owned those really got screwed. And they did that by using their own newly printed money to buy those bills and buy those bonds. Well, as you might imagine, that massively grew the money supply. And some people don't remember this, but it's a fact. I thought it was pointed out recently, and I retweeted on Twitter that, the CPI in June of 1947, the CPI was up 17.6% year over year. In, February of 1951, the CPI was up 21.0%. So what you see is, if we get into a situation where we're going to have yield curve control, the government's going to have to print a lot of money, fine, but that printing is going to cause a lot more inflation. And so, the 9% inflation that we saw as the peak in the COVID example, it could become even higher in the next time around. And I remember the 70s very well. I was a teenager, but I remember the 70s very well. And there were like 3 waves of inflation. And history shows you, once you get into an inflationary cycle, it's very hard to stop it, until you do something really extreme, like what Volcker did by putting rates at 20%. And so, I believe we are now in an inflationary cycle. And, the price of gold and the price of Bitcoin and the price of the bonds, the long bonds, are showing us that. And that's why I partly wrote the book, to try and educate people and warn them that in this kind of a cycle, they really need to have a piece of their portfolios devoted to sound money. Because sadly, I don't think this inflation is going to get better. I mean, it got better when Powell took money supply growth down to negative by jacking rates very quickly. But eventually they're going to be forced to turn around on that. We already see President Trump calling for a 300 basis point cut. And as you know, Jay Powell will be out of there in May of next year. And my sense is Trump is going to get his way. So, I think we have a lot of inflation in the future, Michelle. That's kind of what I'm saying.
So help our viewers understand why it's so devastating, right? Because your core argument is that we're going to get more inflation. That's inevitable. And you've said that inflation is not just an economic issue, it's also a moral one. In your book, you call it theft. So for those that aren't that familiar with it, explain why, who's really benefiting from that theft, who's paying the price. Like we as a society just come to accept inflation as a given.
Yeah, they've brainwashed us and gaslit us into thinking inflation is good and it will fall into a deflationary depression if we don't have it, which is just a blatant lie. I mean, the Fed, the Keynesian economists, the people who benefit from inflation have the rest of us thinking that we have to have some inflation. I mean, my view is, what's wrong with deflation? Who doesn't like falling prices? I mean, take a look at computers, for example, and technical things. I mean, the prices in those things have been falling for years. It's been fabulous, right? But my view is deflation is a great thing, and I try and point that out in the book. And there's a whole chapter on why deflation matters. And Jeff Booth is the best person that started kind of explaining why we can't run an inflationary monetary system with a deflationary world, which is what we've got. But inflation just rips at the fabric of society. Think of, what happens is there's something called the cantillionaire effect, which is just a fancy word for saying that inflation benefits a certain class of people who get the money first and who can borrow cheaply. I mean, if you're on Wall Street or you're a big corporation or you're a hedge fund or you're a money manager, you can borrow at the Fed funds rate plus a small margin. If you're a regular working stiff or average person in America, you can maybe get a mortgage at 7%. That's the lowest cost capital you can find. And after that, you're at the hands of the credit card companies, which kind of look like the mob. I mean, they're charging 25% on average. I saw one that was at 31% the other day. I mean, that's just ridiculous. We used to have usury laws in this country, and they're gone. So, and it just rips at society. I mean, the last time you saw an inflation like this was 1919, where you had a really huge, the price level doubled post-World War I because they printed all the money. The Fed immediately violated its charter and printed all the money to finance the war, and the price level literally doubled. And what you had is all kinds of race riots, you had all kinds of labor strife, lynchings went up enormously. The Ponzi scheme was in 1919, which kind of echoes what Sam Bankman-Fried did. The Chicago Black Sox were 1919. It led to? It led to prohibition. I mean, there was a whole group of people who thought, well, society's falling apart. It's all because of the alcohol. We gotta stop people from drinking. So they passed the Volstead Act, and that really wasn't the problem. The problem was that the money wasn't sound during that time frame. Now they eventually worked their way back onto the gold standard, and things became stable again. And then that kicked off the Roaring '20s. But anyway, that's a long story. That inflation hurts a lot of people, Michelle. And there's a good chart in my book. I don't have it here for display now, but it just shows how much of the wealth is owned by the 1%, and how if you look at the last 20 or 30 years, the wealth of of everybody, the bottom 50% of this country has been just struggling to survive and just getting by, and their wealth hasn't increased at all because they don't own assets. And if you look at the people who own assets, particularly the people at the top who own assets, they benefit from inflation because they can borrow cheap and buy assets that go up more than the cost of the capital. And so it's just a very straightforward, unfair deal. And that's not what the Constitution and the founding documents of this country, promised. I mean, the notion wasn't that we would all have equal outcomes. It's not socialism or communism, but it was that we would all have equal opportunity and a fair deal. And we do not have a fair deal. It's blatantly obvious we don't have a fair deal. And you can see it in so many places. And, my book outlines why and how we got here, and how if we want to go back to that great country that we once had, which had problems for sure, but if we want to go back to a fairer system, we've got to start with fixing the money.
Right. Fix the money, fix the system. We talk about this 2% target, the famous 2% inflation target of the Fed. And I'd like to point out, you cover this in the book, that this wasn't like divinely ordained. This is not some economic law, right? This is a compromise that started in New Zealand in the 1990s. Tell us about that.
Yeah. Well, it started there, and then the Fed did some papers on it, and then Janet Yellen, pursued it very aggressively. And, the whole notion was that they need, the bugaboo that Ben Bernanke sold everybody on was that if we don't have a little bit of inflation, we are going to have another Great Depression. And he totally misread what the Depression was. The Depression was a credit bubble created by the Fed that burst, and therefore, a lot of things failed. And actually, the Fed didn't do the right thing. They printed a lot of money. What they should have done is save the banks. It was the bank failures that really caused the pain in the Depression. But anyway, setting that aside, they've used that, Keynesians, people who are professional economists and the government have more or less gotten in bed with each other. And it's a good deal for the government because they can spend and buy votes and run wars and do the things they want to do. And we all pay for it at the grocery store. And it's a good deal for the Keynesians because by supporting the government, they get huge, checks from the Fed. If you look at most professional economists and most professional economic journals. I mean, to be an Austrian economist and try and make it in the United States, it's impossible because the Fed has kind of rigged the game to support the Keynesian model. And the Keynesian model is just a blatant lie. I mean, Keynes was not a good guy, and on a lot of levels, but we don't need to go there. but his theory is a broken theory. I mean, talking just a minute about it theoretically. Let's talk about what inflation is. Let's talk about what interest rates are. Okay, so in theory, in classical economic theory, what should occur is people should save money, and that's a pool of capital and savings, and maybe they don't have anything that they want to, they're sitting there with their capital and they'd like to get a return on it. And then turn on the other side, there are people who say, look, if you loan me some money, I can use it to build a business or make society better, and I'll pay you interest for that. And so what interest ought to be is the price of capital as set by the free market. It should be supply and demand should set the rate of interest. And what has happened is we've got a price fixing committee called the Fed. And it's like, as Judy Sheldon has pointed out, it's like the Goss plan over in Russia where they're setting the price of wheat. They have too much wheat, too little wheat. If we let the free market set the rate of interest, we wouldn't have 20% interest rates and 0% interest rates, which is what we've had. I mean, the rate of interest has swung all over the place. I mean, we'd have been better off just by saying we're going to have the rate of interest at 4% and just lock it in there forever. I mean, we'd still have had some booms and busts, but it would have been better than this group of economists who don't know what they're doing setting the rate of interest. And so we need to return to a free market system for interest rates and money. And but try and tell that to somebody at the Fed, or try and tell that to a Keynesian economist, and they'll say you're crazy, you're a gold bug, you're a crank, the Austrians are wrong, etc. But if you look at all of the objective evidence, we're dead ass right. And the book, I mean, I show chart after chart of how and why we're right. and
right.
That's part of what led me to write the book too, Michelle. Just as a little backdrop, I was sitting watching some political debate, last year when Team Red and Blue were going at it, and nobody was talking about the core issue. And I was like, guys, you're all arguing about the color of the drapes, and the friggin' house is on fire. And we've got to figure out, you got to get the fire hoses and put out the monetary fire, or else the color of the drapes isn't going to matter. And so, therefore the book.
Well, since the Fed was created in 1913, you write in the book that the dollar has lost over 97% of its purchasing power. You also write that the Federal Reserve is not federal and it doesn't have any reserves.
Right.
And as you just mentioned, that it's really a bank cartel. And, it's phenomenal that we have these 12 people essentially making these decisions that have such sway and influence over global financial markets. Can we have no Fed?
I believe we can. I definitely believe we can. If we return to true sound money, now it's going to be a very different government, and there are going to be banks that are going to fail. I mean, one of the other arguments they made for setting up the Fed was that the banks needed a backstop, and my view is horseshit. Let the bad banks fail. Period. That's how it should be. There should be. I mean, the banks are really a socialist enterprise. I mean, I like to say that the great financial crisis was rugged capitalism for everybody who lost their house or their job or anything else, and it was socialism for the bankers, because the bankers, received $20 billion in bonuses that year, and after all the malfeasance of blowing the housing bubble, they got fully bailed out and were able to keep the profits. There were no clawbacks. And so, what we've done is the system as established, this banker cartel that we've established, has enriched the bankers, enriched the financiers, enriched cotillionaires, and empowered the government. And that's why all those people have done extremely well at the expense of the people who go into the grocery store every day and say, I can't believe this is so expensive. And it's tragic. It's absolutely tragic. The suffering caused by the Federal Reserve is galactic. I mean, it's beyond the pale. And my book goes into that. And I'm quite sure, Michelle, that our kids will, live in a world without a Federal Reserve, and they'll look back at it and they'll say, what were we thinking, letting 12 guys set the price, 12 people set the price of money? I mean, it'll be like bloodletting. I mean, they were, it's ridiculous. So that's where we're headed, and that's the good news. But the bad news is we're not there yet, and we're in this transition period. And so people need to think about how to play the market, or what to do with their savings in order to make it through the transition.
Which will be my next question. How do you get through this transition then?
Well, I mean, at a very simple and basic level, if the problem is the government is printing too much money and they're out of control, which is, I believe, the problem, and it's likely to persist. I mean, sometimes when people say they're looking to invest with me in my fund, they say, Larry, what would cause your fund not to work? And I would say the government would get really responsible and balance the budget, and they laugh hysterically. So, but stranger things have happened, right? But back to the question, the way you deal with it, if the government's printing money and the money is continually being diluted and at a more rapid rate, and that's what we're beginning to see, then the solution is you want to own things the government can't print. And the things that qualify in my mind, there are a number of things. The best things monetarily that qualify are gold and Bitcoin, and a little bit silver. And then beyond that, otherwise you get into real estate because it's a physical asset, and then to some degree stocks. But at the core of the issue, the anti-fiat trade is to be in gold or Bitcoin because the government can't print them. Gold is geologically limited because we're increasing the supply 1.7% a year. Bitcoin is algorithmically limited because the code only grows, and it's slowing down. But supply of Bitcoin only goes up 0.8% per year, and every 4 years, that growth rate gets cut in half. And so, those two things are the solution to the problem. And also, in my view, they're the thing that will protect you as an investor, but they're also the thing that will lead to the failure of the existing system. And frankly, my belief is that the existing system can't fail quickly enough because it's hurting a lot of people. And, I think I'm very optimistic. I mean, people say, well, geez, you're kind of a doomer here, Larry. And I'm like, no, I'm not. I'm just observing the facts of what's going on. And I'm actually quite optimistic about what things will look like and where we're going to go. And all the great technological developments that we've got, AI. I mean, there's so many good things happening in the world. But until we solve this monetary problem, there's financial pain. And I think a lot of people are feeling it.
Well, as you say, you need to fix the money to fix the world. But this transition that we're going to have to go through is not going to be pleasant. And in the book, you connect this to the idea of the fourth turning, that every 80 to 100 years, there's a major reset in society. The fourth turning is a theory of history and social cycles developed by William Strauss and Neil Howe. And it argues that history moves in repeating cycles of 8 to 100 years, divided into four turnings of around 20 to 25 years. And the fourth turning is the crisis phase, a time when institutions break down, society fractures, there's some kind of decisive crisis upheaval that reshapes the system. The last fourth turning for the United States was the Great Depression and World War II. So expand a little more on the fourth turning theory. Where do you think we're in it, and why you say that this one, the core question, is tied to money, and what is money, and why you think sound money will emerge out of this fourth turning crisis?
Yeah, that's a great question. And just to give a little more color to the fourth turning, these 80 or not every 80 years. I mean, the last one was World War II. Before that, the one before that was 1865, the Civil War. And the one before that was the American Revolution. And the noted fact of these fourth turnings is that the world is a certain way. A crisis develops, there's a lot of change and pain, and then, things get fixed and you come out the other side. So, you saw that with the creation of the country. You saw that with the, resolution of the issue of slavery. And you saw that with World War II, which was existential. This one's different, but I think the central issue in this one is actually the money. And I think it's fiat money. Its useful lifespan. I mean, we know historically, looking at other countries, that most fiat monies don't last more than 40 or 50 years. We're 50 some odd years into this fiat experiment. I believe it kicked off in 2008 because that was a really great shock. I mean, the financial system was shaken to its core. And so to me, that was the beginning of the fourth turning. I think Neil Howe, who's still alive, Strauss died, but Howe wrote a book on it, and he agrees that that's the beginning of this one. And these things tend to last, 20 to 30 years. So, that would imply a resolution between, if it started in '08, that would be 2028 or maybe, 2038. And that sounds about right to me. And, we've seen, now two big monetary events, the GFC and then the COVID example. And And we've seen what's gone with it is a lot of inflation. And so it seems to me pretty obvious. And I'm kind of surprised that Howe doesn't talk about this. He admits this might be what the turning is about, but he says that there are a lot of other possible candidates. I disagree. I think this turning is really about money. And I think that when we come out the other side, we're going to have sound money. Because what will happen, Michelle, in my opinion, it's just going to become so intolerable. I mean, it's what Churchill said. We'll always do the right thing after we try everything else. And so we're going to have a lot of inflation. And eventually people are just going to say, oh, my God, please, please, please stop this inflation. We need to have sound money. So I think that's where we're going, but we're in the middle of the path.
All right, stay tuned for part 2 of this interview, where Larry gives us his outlook on how the monetary reset is the crux of the fourth turning, how it could play out, how gold and Bitcoin fit into the new monetary system, and which asset ultimately wins, and why some people in the Bitcoin universe may not be quite as they appear to be. That's all coming up in part 2 of this interview.
This is The Real Story with Michelle Makori.